Hello, everyone, and welcome to our True Methods webinar, your 2018 MSP Business Plan in a Box. My name is Bob Penland. I'm Chief Technology Officer at True Methods, and I'm joined by Gary Pica. Hey, Gary.
Heyo!
Hey-o.
All right, Bob. This is our last public webinar of the year. Yeah. We have
Another
one
one in the
more,
box.
right? We have one more
Yeah.
tomorrow that we're doing for True Methods Formula One members, and that'll close out an awesome year of content, fun,
Yeah.
changing minds, right?
Yep. Yeah. It's
So,
been a good year, 2017, and looking forward to 2018.
yeah, well, why don't you do a little just quick housekeeping,
Yep.
and then we're going to get right into this thing in the next hour. If you're in the recurring revenue business, we're going to show you how to go from your 10-year net worth goal to what has to happen like right now in your business.
Yep.
We're going to lock it down.
Good. So you can listen in on VoIP or you can dial in on the phone. If you dial in on the phone, make sure you enter your audio pin, which can be found in the GoToWebinar control panel. Also in that control panel, there is a questions box. So if you have a question or something doesn't make sense, just go ahead and type it in there, and we'll either answer it in the background or we'll bring it up live and we'll answer it on the air. We are recording this, and we will send out a link afterwards within the next day or two to the recording where you can go and review it or send it around, share it. So without further ado, do you want to get going?
Yeah, we can get going. I'm going to do a couple slides here. While I do that, maybe we can do an audience poll after that
Okay. Yeah,
about
you
where
want to do
people
it?
are. So maybe you can.
Yeah, I got to dial it up
Possible?
here. So
Is that
yeah,
possible?
yeah,
Okay.
why don't you go through your
I'll
thing and
give
I'll
you
do
I'll
this.
give you a
Yep.
couple minutes. So
Yep.
the first thing I want to do is real quick about our background and as it applies to this content. So, I've been an entrepreneur for 20 years. I've owned two MSPs, operated one of them along with Bob, and True Methods for 9 years now, working with thousands over the years of MSPs and IT solutions providers around the world. So everything we're going to talk about today with business planning, one, we've studied and worked with people on for so many people for so long. We're students of this, and it's so critical, but also applying it directly to this business. So taking the principles and applying it to the MSP IT solutions business, and that's what we're going to look to do today. So everything we're going to say is none of this is in theory. All of this is our experience and the experience we see right now today, what we do at True Methods, at our MSP, and the over 1,000 MSPs that we work with this year. So if something we say is counter to what your experience has been, that's the time to ask a question. You're not going to hurt our feelings, and they're usually the best questions. So I want to take a minute and thank two companies that helped us today, Auvik and Barracuda MSP. I'll bring them up at the end again, but they love this content. They think it's important. So they were nice enough to invite their customers and prospect bases to come and share this because they thought it would be valuable to them. And so we really appreciate that they're supporting the industry and the content. Also, I'll bring this up at the end, but the core of what we do here is our training, but also our software MyIT process that allows you to build a true technology, what we call technology success practice, to increase the value of your offering. We have some special pricing going on before the end of the year. If you just email gary.promo@truemethods.com. And with that, here's what I'll say about business planning. Just because you have a business plan doesn't ensure that you're going to grow faster or make money. But almost without exception, the companies that really have achieved their goals, the ones we work with over the past 2, 3, 4, 5, 6 years, that have transformed their business and their lives and their teams' lives, they all have an actionable business plan. All of them, without exception, they are better at this process today than they were a year ago or 4 years ago. It's the one common thread. We have almost 80 companies in a peer group, so we get to see them every quarter. And I'll say more than anything else, the focus on their quarterly accountability and the process we're going to talk about today has ensured that every single one of them has made great progress. So if you want to do one thing better next year that'll ensure that you will grow faster and more profitably, it will be the things we're going to talk about today. Bob, did I buy you enough time?
Yeah. You ready for a poll?
Yeah, let's go. Let's do it.
Okay, so the poll being, do you have a 2018 business plan? There's 4 answers. 1, yes, it's complete. 2, no, but I'm working on it. 3, no, but I'll start soon. And last, no, business plans are silly. So why don't you take a second, send us an answer. We like hearing this before we get going through it. And we got about 60% of the people voted. 65.
Right. Just wait a second. We'll let the rest of the people vote on this. We'll see how the percentages come out, and that's where we'll start talking about how to approach that, and then we'll get into we'll give some concepts, and then we'll move into some real detail about actually the business plan and some keys.
Okay. Okay, one more second here. All right.
All right.
Let's close it up and share the results. Okay, we got about 20% of the people say it's done. Good. And another 50% are working on it. Great. Awesome.
Did anybody say it was silly?
We had 1%. 1%.
There's always 1%.
Yeah. Yeah,
always.
There's always a jokester out there.
Yeah.
Yeah.
I'm hoping that's the case. So here's what you see.
Great.
I'm glad to see we had some people. I would prefer that 100% of people said it's done, at this point, where we are at this point in the year, but I'm glad some people are working on it. Let's make sure you're working on the right things. Here's the top excuses we get why people don't spend as much time or don't do this. I'm already working as hard as I can. Like, I'm buried with reactive work. And the concept there is, like, I don't even have time or resources to take action even if I had a plan. Or I just need to finish a few other things first. Then I'm going to work on my business. Or my company is small. It doesn't need a written plan. The funny thing, Bob, these are all the reasons why you need a business plan.
Right.
Again, after running businesses for over 20 years, I call it the clear the deck mentality. We always want to be more proactive. We always want to be more focused and get our team more focused, but we feel like we just got to finish a few more things, and then we're going to clear the decks, and then we're really going to do all the things we want to do. But I've never come into the office in any of those 20 years and said, oh, well, I don't have any emails today. There's no service tickets. There's no employee issues. There's no customer problems. You know what, Bob, I have absolutely nothing to do. I think I'll work on the business today.
Yeah.
But that's the mentality that people keep having. And so what we're saying is, here's why you do a business plan, so that you can start to make changes and have the right priorities and move towards goals while you're running today's business. In other words, you have to change the tires on the car while it's moving down the highway. You're never going to have the time or money to pull the car off and work on it and get it where you want and bring it back on the highway. We have bills to pay, okay? And we have employees and we have customers. So that's the concept of these things. So the first thing is, that's why the structure looks like this, Bob, where we start with a vision, 10 years. Really going out and thinking about, where you want to be. We'll talk about, the vision. Then targets, and why targets are important is because 3 years is a time frame that's far enough away that we can make some mistakes and have some false starts, have some issues and correct them, and still make those goals. But it's close enough that we can actually see that far ahead in our business. Then a 1-year plan, because that's how we always look at our business and that's how we live with our financials. And then action. So that is your quarterly plan. And the reason you do all the rest is so you know what to do this quarter, Bob. And so many people they call it a business plan, but they really have a budget. They look at last year, they kind of know what's going to happen. They write it down, they put it in their drawer, and it doesn't come out for a year. Or if things go bad and they have a couple bad months, then maybe they pull it and go look at it. The whole key to this is to get to the action. So we're going to work through this process from vision and talk about that. And then we're going to do math from long-term to target to plan to action. We're going to take you right through it. How does that sound?
It sounds good.
So first thing you want to do is you want to review, before you start any of this, you want to review your 2017 results. So how did this year go? And you start with, what was your revenue by category? And by category, I mean managed service revenue, core managed service revenue, maybe other recurring revenue, the things that maybe you sell as one-offs to your customers, product revenue, non-recurring services, and any other types of revenue categories you might have in your business. So they're the main ones for most IT providers. You also should be able to look at your gross margin by category. You should be able to know what your gross margins are, just like you should know what they are on product. You should know what they are in non-recurring services. You should know what they are in managed services and any other recurring revenue that you have, okay? If you don't know that, this is the time to look at if you're using QuickBooks or whatever you're using for accounting, to redo your chart of accounts, because you need to see revenue and costs so that you can understand what your gross margins are. But if you don't understand that, you can't really do a business plan. Like, we know at our MSP that, our product revenue is around roughly 20%. We know that we're at, that we target 60 to 65% on non-recurring services and 70 to 72% gross margin on managed services. We want to make sure we're in that range, because at that point, we know the right mix of products so that we can maximize our gross margin. That concept makes sense, right?
Yeah. Yep.
Okay, next, new MRR sales, monthly recurring revenue. So how's your sales engine? How much recurring revenue did you sell last year? How much did you lose and why? What was your churn? What is your current all-in seat price? So take all of your recurring revenue divided by all the seats you support. That is your all-in seat price. And that's really important, because your gross margins are the difference between your average all-in seat price and your average cost per seat. And many people don't track those things. So we see them, they're at, $85, $100, $110 a seat. And we know what their costs are in this business. We know they have to be at 140 to 160, but they're not tracking these things, so they can't calculate them. And your average MRR. So take your recurring revenue divided by the number of customers. That gives you your average deal size. Also very important. And you should look at that, Bob, for your current base, but also look at it for the sales you had last year. In other words, are you selling at a higher price than average now, so you're moving in the right direction? And then finally, your ticket noise, or what we call REM, reactive hours per endpoint per month. And Bob, this is really something we teach in our training. And the reason you want to look at this is you want to know, as a percentage of your time, how much of it is spent on tickets and alerts, right?
Yeah. You want to, we talk about high value services versus low value services. Fixing issues, it's something you have to do, but it's something that isn't of a high value. So over the course of time, we want to drive down the amount of what we call ticket noise, or the amount of time we spend on unscheduled reactive type tasks.
Yeah.
So the things that come in that are requests from users, or things that are issues, like, we want to spend as little time on that as possible, and more time available to spend on high value.
And we're going to show people the math
Okay.
a little bit later in the webinar. In the second half hour, we'll show some people the math so they understand that. Okay.
But at a minimum, you should be tracking this. At a minimum, you should be tracking it. You should know it.
Yep. And if you don't feel that way now, after we show you a couple slides of how this impacts your business, hopefully you're going to want to track it, because it's a big part of your business plan and your profitability and your value.
Right.
Okay, let's start with that vision. If you're an entrepreneur, Bob, it's really hard to separate your business and your life. Okay.
Yeah.
They're very closely tied. And so you need to think about both your life and your company. Like, what is your vision for where you and the company will be in 10 years? Okay. Do some soul searching. Like, how big do you want the company to be? How many employees? Like, how profitable should it be? Um, Even going and thinking about, why did you get into this business, and have your expectations changed? And most people I talk to, Bob, they got into this business because they felt they could do a great job and help customers. And what they've learned is, um, there's a lot more to business than just taking care of customers and employees.
Mm-hmm.
And that to obtain a level of financial security from the risks that you take is not easy to do in any business, but especially in this business. It's a very difficult business. So when you think about those things and where you want to be, and you look back on where you've come from, you got to put a price tag on your life's vision, because money and time are just two sides of the same coin. So that's where we want to start. We want to put a number on your life's vision, okay, a price tag on it. And then we want to work backwards, and then we want to make sure that that matches up with your business goals, and for you, and also for your team members. You want them to be able to achieve a level of financial security. Um, but you got to start with you, because I know one thing, Bob. You and I and a couple other people here, we've worked together at a couple companies. Um, you know, uh, as an, your financial, and we're partners. You and I are partners in the
Mm-hmm.
in the MSP business. Your financial security is important to me. But if I can't figure out how to run my business in a way that I achieve a level of financial independence, I can't give you something that I don't have, right?
Right. Right.
So it's important to everybody. So we start with this, Bob. This is the obvious place to start, don't you think?
Yeah. I mean, is there any questions on this? I mean, it seems pretty obvious to me.
All right, we'll give people a little bit more on this. This stands for after tax dollars in your personal bank account. After tax dollars in your personal bank account. And it's one of the reasons why everybody takes the risk to be in business. Okay. To get this, here's what has to happen. First, you have to sell something. Then you have to deliver it. Then you have to bill for it. Then you have to collect. Then you have to pay your payroll. Then you have to pay all your overhead. If anything's left after that, you got to pay taxes. Okay. After you pay taxes, you got to pay your personal living expenses. This is what's left after all of that. And so this is a great place to start, is setting a goal for after-tax dollars in your personal business account, because too many people just really take a salary and a little bit of bonus from their business. If you think about it, your salary is for doing your job. This is your return on your investment, Bob, and your
Mm-hmm.
company is an investment. So we're going to start with something that we call the liquid net worth goal. And a liquid net worth goal is, you want to set a goal for how much additional money you want to have after taxes in the bank, excluding the value of your business in your home, because you don't know what your business is going to be worth or how you get the money out of it. And you also don't, and you have to live somewhere. So um, this is the simple way we're going to look at this. And then we want to consider life events. So think about, like, in your goal for how much money you need to generate after taxes. Do you have kids that you want to send to college and help with that? Do you have an elderly parent you may need to take care of? Do you have the dream of having a vacation home someday? So consider all those things when you come up with your goal. And we use the number of 1.5 million just as an example. And so for our example, we want to have 1.5 million more dollars in the bank after taxes in 10 years than we have today. Now, this could be your goal. Your goal could be 2, 3, 4, or 5 times that, depending upon where you are and where you're trying to get to with your business. But we're going to use this math because it's simple, and we're going to relate this so you understand the correlation between this and your business. And it starts here. So the first thing we're going to do, we're going to take that goal of 1.5 million and just simply divide it by our time horizon of 10 years. And that says that every year we have to pay all of our taxes, all of our personal expenses, and then we have to have $150,000 that we can take out of the business and be able to put towards this. Now, we didn't consider, Bob, the time value of money, any of those things, because we want to keep this simple. So we just divided it by 10, right? So
Mm-hmm.
we're just going to put that in the bank for 10 years, and we're going to end up with that 1.5. So that's
Right.
conservative, right?
Yep.
Okay. Now, how much additional income will we need? So our annual income, do you need to generate the 150? In other words, we got to gross it up for taxes. So if you need an additional $150,000 and you're in a 35% effective tax rate, although right now no one knows their effective tax rate as of today. If you're in the U.S., no one knows their
Yeah.
effective tax rate yet. But let's assume it's 35%. That means you need to generate income, right, of $230,000 additional from where you are today, because we're assuming that you have income and you pay your bills today. So you have to be able to pay the tax to get to 150. So far, so good, Bob?
Yep.
All right. Okay, here's where the magic starts to happen, Bob. So we're going to do 3 important things here. And if anybody has a question before we move on, this is super important. This is when we're going to relate your personal goal. Now we're going to turn it into a business goal. So the way in which we're going to do that first is to say, okay, if the way we're going to generate this $230 pre-tax is additional revenue from our company, additional profitability from our company that we can take, how much annual revenue do we need in our business to generate an additional $230,000 of profit? So if we divide it and assume you're at 18% net profit. Now, that's an assumption, and we're going to show you if you're higher or lower what that means. But I know that we just saw some stats that, the top quartile, the top 25% of MSPs are around 18%. So that's a good number to use. You want to be in the top quartile. Unfortunately, Bob, the mean was 8%, and the bottom 25% with the true owner salary were actually below break even. So we're going to show you the impact of that, but we'll use 18%. If we divide that, you need $1,275,000 of annual revenue at 18% to get to 230 to pay your taxes to get to 150. So far, so good?
So far, so good.
Okay. Now, the way in which we're going to drive our business as MSPs is through recurring revenue. So what I did here was I took that 1.275 and I said, I believe that 70% of our revenue is going to come from our monthly recurring revenue, or MRR. And I said that because, we get a customer that pays us, 3,000 or 4,000 a month. They're going to buy some product. We're going to do some non-recurring services. So there's other revenue that gets driven from those customers. So I use 70%. You can use your own. Maybe you're at 60% if you have a little bit more project revenue or hardware, but I use 70%. Because if we drive that, we know the other revenue is going to come, right? Because it follows along pretty consistently.
Mm-hmm.
So that would be 892,500 of annual recurring revenue. The last thing we did was we divide that by 12 to set an MRR goal of 75,000. So think about what we did here, Bob. We took the additional pre-tax earnings goal per year. We turned it into a revenue goal at 18%. Then we turned that into a recurring revenue goal, and then we divided that by 12 to come up with a $75,000 MRR goal, which means if we can generate net $75,000 of new monthly recurring revenue over some time period, we will have the business and we'll be that we need to achieve these goals. Really important, right? Because we've now taken a number and made it a focus. Now we have one focus that we can rally around and set our priorities on that we know is going to drive results, Bob.
Yeah, and we're taking this big number that seems really far off and starting to get it down into something that is more manageable.
So let's use this 75,000 additional MRR. Let's use that as our target. So we went from our 10-year goal, right, of 1.5 million of additional liquid net worth, and now we're going to turn this into our 3-year target. So we're going to set this time frame and say we want to be there within 3 years, and that's a pretty good goal, because if you can get to your goal in 3 years, you're going to surpass it after those 3 years, like if you can generate an extra $75,000 in 3 years, you're not you've figured out how to do it. So you're going to exceed your goals. And again, we want to be conservative all the time. So this is also conservative. So now we want to determine our 2018 MRR goal. So we divide it by our time frame. So if we divide 75 by our 3-year target, our net MRR goal is $25,000 for 2018. Now, again, Bob, this is net, so we got to consider any churn we might have.
Yep.
So if you think you're going to churn, 5,000, then maybe your gross sales goals would need to be 30,000.
Mm-hmm.
And I would say this: the reason we picked these numbers today, many people's numbers are going to be much higher than this, but we picked a goal that backed into a number. Like no one should have a goal for less than $25,000 or $30,000 of MRR in a year in this business today, in today's business. Would you agree?
Yeah, I mean that's got to be the absolute minimum. If you're
everyone
right,
can do that.
Right. I personally feel it should be 36,000, but
right, that should be the minimum, 36,000.
Right.
So, but we set 25 just so that everybody can see how achievable things are. Someone said, what do you define as churn? That's lost MRR. So we're trying to net. So we sell new monthly recurring revenue, and if we lose some for whatever those reasons are, that's churn. It could be good churn, it could be bad churn, but we have to live with the net. And if we want to get to that additional 75,000, we have to, outsell that.
Good.
Okay. So the next thing we want to do here is something we use in our training program called the MRR calculator, which is we want to figure out what has to happen now. Like, what do we need to do in a shorter term to be able to achieve these goals? Like this month, this quarter, okay? So the first thing is you input your goals. I put in 25,000. I said our average contract size is 2,000. That should be the minimum. Everyone should be higher than that. Your average customer should be more than that. And I use the 20% close ratio. So we need about 1 deal a month, roughly, Bob. So in order to do that, based on the calculations and us working with so many people and being in the business for so long, we know kind of what the ratios are. We set this up to say, in order to do that, at any given time, you need 4 or 5 prospects worth 8 to 10,000 a month of recurring revenue. If that has to be your strength of PBR at all times for this to happen. In order to do that, you'll need to go on 60 appointments or first-time appointments, 60 new leads or prospects that you're in front of, which is about 5 a month or about 1.2. We even know if you're making dials and contacts what that needs to be. So this is the first place. So many times I ask people, hey, who has an MRR goal? And they say, I do. Okay, what is it? 25,000. All right, so how many customers do you need? Sometimes they know that. And then I said, all right, so based on that, how many prospects, like how many leads do you need per year or per month? Well, I don't know. Well, how many do you generate now? I don't know. I'm going to suggest they don't have a goal, Bob. They have more of a hope or an aspiration, okay? So now you can look at this right now and say, do I generate 5 good leads a month? If the answer is yes, you might be on track to get there. If the answer is no, you generate 1 or 2, then in order to get to your goal, your priorities have to be to figure out what are the activities that I need to do to get from 1 or 2 leads a month to 5 good leads a month, right? So already we're getting focus from understanding our math. So let's look at the thing in whole, what we did here, Bob. Most of people, when they go through, we have a whole bunch of videos on this in our training program. When they start with this process and they start their first pass, and they write that big number down. They write down that 1.5 million. They're writing down all those zeros. The most common feeling people tell us they get initially is nauseousness, because compared to where they are, it's big. And when they get down and they see they need almost $1.3 million more of annual revenue, they might only have $1.3 million of revenue today. It looks huge. Again, still nauseous. But once they get down to 75,000 a month and then 25,000, for the year that they need, and then 2,000 a month, and all the way down to just a focus on getting 1.2 appointments per week, that feeling starts to change into something that's much different, something that is excitement, something that's achievable, something that they can start working on right now. And they know if they start at this bottom math and they work their way up to that 2,000 and eventually to that 75,000, all the other math is going to take care of itself, Bob.
Right.
That's the beauty of this business. That's how we got the first business from 0 to 7,000 endpoints and over $500,000 a month. Giving the young owner of our current MSP this math and this logic and this focus on doing first things first is what got him to $250,000 a month, right, of profitable recurring revenue.
Right. Jim Collins calls it the 20-mile march, right? And what are those steps you need to take to get to 20 miles? And it's not by sprinting in the beginning as fast as you possibly can. It's figuring out what's the rhythm day after day, week after week, quarter after quarter, year after year that you have to do to get to whatever your goals are.
Yep, absolutely. So to achieve your goal, there's two pieces. One of is profitability or net profit percentage, and the other one is your sales ability, your trajectory, like your net MRR gain. Everyone thinks their issue is a sales issue, Bob. That's what they think. If I just sold more, I would make more. And statistically, we talked about what the mean percentage of profit is. That's just not true for most people.
Right.
And it is profitability that is going to have the biggest impact on your financial future and on your team's financial future for great opportunity for them. Let's show you how this works. So in the center is our math at 18%. Look at what happens if you're a 12% net company, okay? If you're a 12% net company, instead of roughly 1.3 million of revenue, you need almost $2 million of revenue. Instead of 75,000 a month additional net a month, you need 112,000. Instead of $2,000 a month in sales, you need 3,000. So you can just see, for some people, this is the difference between goals that are achievable and not. Now, we ran our first company at 30% net, okay? And we see a lot of MSPs that are using the right approach and some of the framework that we give them, they're running in the 25%, range, 25%, and they're growing towards this. If you can get there, look at what it does. You only need $45,000. You only need $1,250 a month. You either can assure that you'll get there, or you can cut the time frame down. Okay.
Right.
And I did it the opposite way, saying, let's just say you can achieve those goals. Look at what you end with. You'd only get to $1 million at 12%, and you would get to $2.5 million at 30% for the same work, Bob. Okay. So this concept of understanding profitability is super important to your business plan. You can make these numbers so much more achievable if you understand how to drive up profitability. The problem is percentages are hard to make the business decisions on. So what we've done is come up with a better, more concrete number we call leverage. And because your profit is determined by your leverage, and we coined this term to mean the amount of service revenue, annual service revenue you generate per employee. So you want higher profits, but you drive leverage. Here's what that looks like. An average MSP would, let's say they have 6 employees. They would have about $600,000 of total service revenue. So no product revenue, just recurring and non-recurring services that they deliver. So they generate about $100,000 of annual service revenue per employee. We set a target of $150,000 or more per employee. So the same 6 people would generate $900,000. So they would have $300,000 of unrealized profitability in their business. So you can figure out your unrealized profitability. This is a great time to do it so that you can put this logic into your business plan. So take the number of employees in your business, including you if you work in the business, not just technical employees, but everybody on your payroll, okay? And multiply it by $150,000. Then take that number and subtract from that what your actual annual service revenue will be for this year. We're at the end of the year, so you should know what that is, both recurring and non-recurring. That is the amount of unrealized profitability that you have in your business. That's the difference between where you are and where top MSPs are. And we work with, you know, on the True Methods framework, we work with 20% of the MSP mentor, you know, top 501. So we see what this looks like. This is the difference between you and them. And you don't just want to set a sales goal. You want to, at the same time, be able to close the gap on this profitability, because that's what's going to make your numbers really achievable in terms of your future. To get there, we're going to tell you that there's two key factors that impact your leverage and profitability, but also we're going to talk about how you can get more, you know, the value. So that's the first thing. Your average seat price. You're not going to get the leverage you need at 185, 110, 115,000. I mean, $115 per seat, because we get to see people's. They don't capture 100% of their costs. We get to see the average seat cost. Okay, and we know that most people are at least $40 or more. And if you're $40 or $45 a seat to get 70% gross margin, that's a $150 seat price, Bob, that you need to be at. And that's the other common thing. Top companies that get into that 18+% range on profitability, they usually have a seat cost in the 140 to 160 or more range. The other thing is reactive support hours, because this is a huge cost in your business, is your reactive support. We mentioned it, REM, and we're going to talk about that. So here's how this works, okay? Here's how we'll tie all this together so we can take this business plan and you can actually look at it for your particular business that we're all in together. That you want to look at what delivery areas that you have in your business. And there's this value stack. At the bottom is the current MSP business, Bob. Everyone does professional services. Everyone does centralized services. Everyone does support. Everyone gives some advice. There are the things that everybody does. They're becoming commoditized. We all have access to the same, you know, tools and technology. At the top of that stack is the things we're doing. We call it net admin and VCIO, technical alignment and business impact, where we're able to look at a customer's technology and learn about their business and have process and resources and people devoted to it. But we only have so many resources. So the more of them that are spent in that reactive role, the less valuable our services are. Does that make sense conceptually, Bob?
Yeah. Yep.
So maybe you can take a look at this and explain to people like how this works.
Right. So REM, reactive hours per end user per month. If your REM, if we look at that column A, if your REM is about an hour, and you're supporting about 1,000 endpoints or 1,000 users, to solve all that reactive work, you're going to need a little more than 6 people.
Yep.
Which means you're going to be able to support, for each one of those people, you support about 140 end users, right? So the monthly cost to support one end user, just for the support side of things, just fixing problems and responding to alarms and moves, adds, changes, that stuff, is $32 for every end user that you support, every seat you support.
Yep.
So if we look at what happens in column B, if you have half the amount of REM, right, 30 minutes, your cost per seat goes down to $16. That halves. And as we go down the line, C is half of B and D is half of C. So, Gary, you and I have run all of these companies.
Twice.
Right? Twice. Company A, where our hair's on fire and it feels like we don't have enough time to solve all the things that we need to deal with. And company D, where it's really smooth and we're way at the top of the stack, and our value is up there. So it's counterintuitive. Company D, a lot less cost to run support, but is a lot more valuable. You're able to charge a lot more, even though you're technically, you know, what our clients like to say is doing less, right? I don't see your guys here. I don't call you as much. But we're doing more of that strategic consulting. Whereas company A, you have 6.25 resources of tickets to do, but you probably don't have that many people on your support desk. It's probably
you have 4 and everybody else is doing tickets. That's what happens.
Right. Yep.
And so, you know, if I said, if you want to sell at $150 a seat, you only have $45 per seat per month of cost. If 32 of the 45 is in support, how valuable will you be? These are the company A are the ones that we meet when we first meet them. They say, I couldn't get those prices. No, not with $32 support cost. You can't get that because that's all that's worth. Okay.
Right.
So most people that we start to introduce to the framework, to the True Methods framework, they're usually somewhere between 16 and 32 when they get there. Okay. And we're saying that all the top companies, they're between B and C. They've gotten their REM down under 30 minutes, and their cost per seat just for support is $10 or less. When you get to $10, you start to command a higher price. Your culture starts to change. More people are involved in alignment and VCIO than in support. When that changes, the whole business changes. And this is the reason why, Bob, the value piece of this and understanding what drives value is the reason why the people that sell the most recurring revenue, the people we work with, like our MSP and many others that are adding, 40, 50, 60, 70, even some people $100,000 of monthly recurring revenue in a year, they're almost always the ones that also are the highest priced. And that's counterintuitive at first because you would think the lowest priced people have the most volume like in other businesses. But in this business, they've pushed down their cost of support, they pushed up their value of their offering, and they're able to actually sell more recurring revenue at a higher price. Boom.
Boom.
And here's what that looks like. So again, two MSPs, they both have 50 clients, they both manage 1,000 seats. One of them has lower REM, higher value. They command $150 a seat compared to the one in white below at 100. And there you see the difference between, literally generating $150,000 a month compared to 100. That's $600,000 to the bottom line on the same 1,000 seats, Bob. This is why the mean profitability and the bottom quartile and the top are so different. Like they're dramatic. There's
Right.
25% of companies that are making all the money in the business. This is the reason why. So you can't do a business plan without understanding these fundamentals and what lies, beneath them. And that is why we built our MSP to get to 30%. And all the people that we're teaching with our training and our platform, MyIT Process, is how to build a framework that lowers noise. You can manage standards. You can do technical alignment easily. Then, in a simple way, be able to report to customers what the business impact of technical misalignments are for their particular business. Build that business relationship and a client strategy so that their relationship with you is a business relationship first, a technical relationship second, and it's based on a process that's repeatable that multiple people can do and get the same results. If you can do that, and that process is going to drive down that reactive noise, and you have more people on this process, you're going to drive up your sales and you're going to drive up your seat price. So with that, let's talk about factors that impact your sales. Okay. One, you got to have a sales plan. We gave you a little peek into it, and we're going to send out the link for this video so you can rewatch it of how we came up with the numbers. You can use our math for your goals. If you're a True Methods member, you can use the sales goal calculator in our business planning tools. So have a plan, work out your numbers, and know what has to happen on a monthly basis, not just for sales, but for activity. Then have a sales process. I'd love it to be our process, but I'll take any process, something that's repeatable, okay? Then accountability. You got to once a week be accountable on the activity level as well as the results, and you have to know that sales math. And I want to just spend a little bit more time on math to help people. Your MRR goal is equal to this. Here's the formula. Number of FTAs or first-time appointments, that's the people you're meeting with, times your close ratio, times your average MRR. So there's your goal of 36,000, Bob, that you were talking about.
Right.
So during the course of the year, if you go on 75 first-time appointments, you close 20% of them at 2,500, you would make your goal. So what we know is if you want to have the fewest amount of leads, because that's going to be the least cost thing to do, there's only two levers. You can have a higher close ratio or a higher average deal size. And this is why this number of average MRR, what your average customer pays is so critical, not just to profitability, but also to sales. Because if your average client's only worth $1,500, you need 24 clients at 20% close ratio. You need 120 leads or first-time appointments in the year. If it's 2,500, you only need 75. If it's 3,500, it's 55. At our MSP, we started out under 2,500. We're over 3,500 now. That's why we sell more. Our math works in this favor. Look, if you can move your seat price and your value from 100 to 150, that alone is going to raise your average MRR by 50%. So this is what makes your efficiencies. Because most people can figure out how to get 50 leads. They can't always get 120. And by the way, do you want to implement and onboard 24 clients or 11, Bob?
I'd rather do 11. Yeah.
So next, how will you and your team be accountable? Like, what is your discipline around business planning? Do you have a day for strategic planning every quarter? Are you measuring? We have something, 20 numbers. We have our True Methods members track called Smart Numbers. Do you have the right metrics? Do you have a meeting rhythm, like with you, even if you're by yourself, or with your team when you look at things? And it's all this built into your culture. So accountability, super, super important. Bob, we plan our plannings and these kind of things a year in advance at our companies.
Yep.
And we have two different perspectives, because here at True Methods, we have a coach that helps us with business planning, but Bob and I work at True Methods every day. We don't work at the MSP. We're only involved in business planning. So it's much easier for us to tell them what to do, Bob.
Yeah.
Right? But here at True Methods, where we're dealing with the day-to-day activity, just like everyone listening today, we got to work hard to keep strategy. And I call you the wet blanket, right?
Yeah, chief no-sayer.
Because I walk in Bob's office every week, but like, oh, I got this great idea. We should do this. And he looks at me and says, okay, do you want to do it this quarter? I'm like, yeah. He's like, okay, well, what do you want to take off that we already said was most important? And I'll be like, oh, Mr. Reality. Because you got to say no to things. You can only say yes to a few things. And every quarter, you got to set just a few big things that tie back to your goals. And you got to make sure they get done every quarter. And you got to say no to everything else.
Right. That's the hardest thing to learn, because there's so many good ideas, and there's so many things that we have to do. Prioritizing and completing a few things every quarter is really difficult, but I'd say that that's really changed how we're able to execute and reach our long-term goals.
Yeah, when we're busy. I mean, Roy is telling us, will this presentation be available? I received a couple calls from clients during this call. He couldn't even put this hour aside. And I'm saying that in a nice teasing way there, Roy. We love you. Right? But there's a great example of what we deal with, of why this is so critical. Here's what we learned. The real impact of getting started with this takes time to fully realize. And if your business grows, it becomes more complex. You need to continue to get better at this. The more I learn about business planning process, the more I want to learn. And I believe I could go into any business now because of understanding and having worked on this for so long.
Mm-hmm.
We got a bunch of great stuff in our training program. So we have a video series all about how to prepare, do your plan, how to really focus just on that, like do that quarterly action plan that's most important. We didn't have time to dive deeper into that today. Maybe we'll do that at another public workshop, but we have a sales plan workshop, and also we just did a sales plan peer. So we had 3 of our members come on and talk about their sales plan for next year. We have stuff on company purpose and core values, getting outside your comfort zone. We also have tools. We have a business plan template, a quarterly action plan template, and a sales goal calculator. So if you need more help, part of our program that we do is all of that.
Right.
So let's do a summary. We have a little bit of housekeeping. We have like 10 minutes, and I tried to get through fast because we got a bunch of questions here, Bob, and I want to try to answer them all. Okay. So in summary, this is the way you want to think about your business planning: your vision, your target, your plan, and most importantly, your action. Then set a 2018 goal for MRR and the supporting activities using the information we gave you. Calculate your unrealized profitability using the formula that we also talked about today, and then focus on value. We call this superpower, Bob. building this technology success concept, that top of the stock activity is going to drive down REM and drive up value. I mean, that's the center of really what we teach. That's what our tool My IT process is for. But you got to focus on value, because in order to sell, you have to be able to create separation in the sales process. In other words, Bob, it's you and 2 other MSPs, and they come down to you. And here's a good example. They come down to you and one other one, and they say to you, hey, we really like you. We're down to you and one other MSP, but you're $500 a month more. Why should we buy from you? And what most people say, Bob, is, well, we have great people and great technology. We have a lot of experience. We've been in business for 10 years. And what I always say to them is, do you think the other person's coming in and sitting down with your prospect after you and saying, Mr. Prospect, first thing I want to get out on the table, full disclosure, our people are good, they're not great.
Right.
Our technology's a little, glitchy. We try to be proactive and prevent issues, but in reality, we create more than we prevent. No one is saying that. They're all saying the same thing that you are, Bob.
Yeah.
Okay. So you have to be able to show them a specific process. That's what we focus on. We give the general term we're using now, we announced this year, as technology success. Underneath it, our members today know us as their superpower, but a process that's tangible, that you can uncover pain and relate it so that you can become more valuable. Because remember, Bob, we're a small cost to our customers. If they spend $3,000 a month with us, they probably have $200,000, $300,000, $400,000 a month of other expenses and overhead. So whether they spend $3,000 or $4,000, we're still relatively small. So if we can show them the impact on those big costs, this is the reason why in every marketplace, we see people that are at $80 a seat. We see them at $120, and we see them at $160 in the same marketplace. Okay.
Right.
And then put accountability in place. Okay. I just want to thank our sponsors today, Barracuda MSP. They're at barracudamsp.com/demo, and what they're doing around a whole bunch of stuff, starting with what they're known for in terms of backup and disaster recovery, but they've really opened up in terms of their offering in different areas to help MSPs. So we appreciate them supporting us today and inviting people to the webinar. So go check out Barracuda MSP, and also Auvik. You can go to auvik.com/true18, TRU18. And if you book a demo, they'll give you a $5 Starbucks gift card. Listen, with most people having hybrid environments now, more stuff moving to the cloud, understanding the issues and what they're doing around network management, you got to at least educate yourself right now about this, because these are the kind of issues that pop up if you don't avoid them, that one of them could burn up all your REM for a week or a month. So check out, and they're great people. And then finally, here's the reason why people do business with True Methods. At the core of it, we have our software tool, My IT Process, that is a framework to be able to build value. It builds your superpower. So that process of developing standards, we also just announced that we're offering security standards inside My IT Process moving forward. We're about to release those early in the year. Standards to be able to perform regular technology alignment, to easily show your customer the impact of technology misalignments, and actually build the strategy for every client within My IT Process. So, and be able to show the value of it really simply. And that's going to reduce your reactive noise. It's going to increase your sales separation. And that's how you build recurring revenue. In addition to that, we bundle in with that our Formula One program, which is over 200 hours of role-based content on every aspect of this business, from sales to lead generation, to service delivery, to profitability and metrics. So we have some special pricing on our bundle that includes our software and our training right now that's really affordable. So if you email gary.promo@truemethods.com, that's TRU methods, no E in true, somebody from our team will reach out and explain to you more about what we're doing. And or you can just reach out and they'll ask you some questions about your business and give you some free advice. They're happy to do that too. They're really knowledgeable. Okay, Bob, we got about 5 minutes. Can we start with the question about marketing?
Yeah, the one from Caleb.
Yeah.
Does marketing strategy play a key role in meeting monthly, weekly lead generation?
Here's what I would say. I would say lead generation activities, and they include marketing, are super important. So what we try to teach people is not just generating leads, but generating what we call warm leads. So these are leads where people already have some need that's in place, and we know that they're a fit. So at the center of those, there are some warm lead activities around something we call centers of influence, something else we teach called Warm 250, and some things you can enhance using LinkedIn with that are at the center of it. Then above that, you have inside sales to generate more volume and clean your database. And once your database starts to look good, there's a lot of other marketing activities that you can do that support it. In addition, you should be thinking about your inbound marketing, content marketing. So, but what we explain to people is some of those things, depending upon where you are, have greater return. And they may have more return when you do other things first. So set reasonable goals for both marketing and other lead generation activities. And we try to say that most people need leads, but they need leads they can close. So we have to balance finding the kind of leads that we can close in the next 30 to 90 days with building our list so that we have more people that are ready to buy from us a year from now. And if you can build and approach it that way, then you can set reasonable and achievable short-term goals, and you can start to increase your goals for sales, as each, quarter and year goes on. That's it, right, Bob?
Yep, good.
All right, next.
Jeff asked, should this business planning process be done by the business leadership team, or is it driven by owner or owners of the business?
So here's how it works. Like in our two businesses, here's how it works. We do them with our leadership team. So the leadership team starts with this process, but then we do get input from our teams about their specific areas, and then we match those up. So the goal is that every service delivery area, every team should have a quarterly goal and also a quarterly action, some things that they're working on that tie back to your annual plan. That's really, Bob, what we try to do in both businesses, correct?
Yeah, and I would say the life and business planning part, like that, the long-term goals, and that should be done by the owners of the company.
Right.
So, but it really has to become meaning for the rest of the people in the organization. They have to feel like they have some input into the direction of the company. So I would say that this is something that starts with the owners of the company and then does follow throughout the leadership team and the rest of the company.
Yeah, absolutely. That's a great point. But the more people you get involved in terms of having a quarterly action plan that will tie up to those goals is super important.
Right.
That's how you create a heartbeat, in your company, even if you're small with with a couple of people. That's really important. In fact, it may be more important, right?
Right.
Because you don't have as many resources. So that's a good question. One I want to answer here was, what are you seeing with clients that shop around hardware quotes? What tips do you have for maintaining margin on products you sell? So you're not going to probably like this answer, Ann. Our customers really don't shop around. That's why we're at 20 or 22%. Here's why. All of our customers are recurring revenue customers. All of our customers, we're implementing our process of standards, alignment, business impact, and strategy. So we have this business relationship with them at a pretty high level, and then a technical relationship. So they pretty much sign our quotes, Bob. And that's in our current MSP, and we did it for 12 years in the previous MSP. Once in a while, you have someone, if they're buying like a whole bunch of PCs, maybe in that scenario, but the core stuff that they buy, whether it's recurring or non-recurring, whether it's servers, virtual servers, cloud services, backup, firewall, we're integrating it. They're getting everything from us, and that's how you get it, Bob.
Right. Yep. Good.
Would you recommend letting go of clients who refuse to come under a managed service
that's what I was
contract?
going to read.
Yeah. So Bruce, here's what it is. I mean, if you can, yeah. Here's in reality what happens. People make a mistake. They go to their customers and they say to them, "Oh, we're going to this managed service thing. We're going to install some tools, and you can call us as much as you want, and you're going to pay us $2,000 a month. On average, you only pay us $1,000 now. How do you like me so far?" And they're like, "No, I'm already happy. I'm not going to pay you any more," because you really didn't give them a reason. So if you can build this framework and build a superpower, and you can go to them and say, "Listen, can I tell you why you spend $1,000 a month with us, and all of my new customers spend $2,000 and think it's the greatest thing in the world? Let's talk about what we're doing for them that we're not doing for you. Let's talk about what your average ticket counts per end user are, and the cost of that to you, and what it is for other people. Let's talk about the risks you have, because we don't have the time to do alignment around your security, around your." You show them and say, you go there and present to them a different end result and a different value. And a percentage of them are going to get it. Some of them might not be good prospects. Like if you met them today as a prospect, you would have qualified them out. And those are naturally over time, as you build the right customers, they're naturally going to find their way out in a way that doesn't hurt your business. Everyone has to deal with that, man. Everybody. All right, we're top of the hour. Maybe one last question, and then we'll roll.
So Caleb asked, what are the variables that you consider as important to clearly define warm leads? Like, how would you define a warm lead?
Okay, so somebody who hits your website is overall not necessarily a warm lead, because they might not, their need might not be exactly what you're looking for, which is a core customer that wants to improve their environment and sees that investment. Okay.
Mm-hmm.
They might not even be the right size or vertical that you deal with. You don't know enough about them. As opposed to, I work with another vendor in the industry who's a center of influence. They have the same target market we do. They deal with the same decision makers we do inside those companies, and they know what a good prospect looks like for us. So when they give me a referral, I already know they're going to do something, or they wouldn't be referring me. They know what a good prospect looks like for me. And so that would be a warm prospect. The warmest prospect would be someone who fits that category that I didn't sell a year ago, that knows a lot about us and is inviting us back in. We call those returning prospects. That's the warmest.
Yep. Good.
All right. This was awesome, Bob. Thank you for your help.
Yeah. Thanks everyone for attending. Thanks to our sponsors, and thank you, Gary.
Make it a great day.
Take care.